Since we just covered UPS, I thought it would be amiable to also cover Fedex, stock ticker FDX, currently trading at $232.10. Over the last year, they are up 13%, but if we zoom in a bit to just year to date, they are up almost 31%. And to dive a bit deeper into why that is, you can see here that the company's cost savings plan were laid out this Wednesday, where they outlined plans to reach $4 billion in structural cost savings by the close of fiscal year 2025. Recently, they hiked the dividend by 9.6%. Prior dividend was 1.15 to a new dividend of $1.26 per share, forward yield of 2.23%. So all of this has been a key driver behind the year-to-date growth so far. But what we really want to do is take a closer look at finding out the fair value of Fedex. So if we go into the stock screener, punch in FDX as a stock ticker and wait for everything to auto-populate, you can see here that the PE non-GAAP forward ratio is 12.6, which is a bit higher than the 5-year average. The dividend yield is currently not updated here since it's a forward yield being updated, so this will update obviously to 2 point something as mentioned before. Payout ratio 36% is also really good. We can see here that it's dangerously close to a 52-week high of 248, where the 52-week low is $142. The analyst target price is 239, so roughly in line with what we have right now, and the current growth target is 4.3%. EPS growth above 10% is at 5.3, and the return on equity is at 12.1%. Jumping into the dividend data tab, you can see here, if we zoom in a little bit, you can see, take a closer look at the dividend data from the different years. You can see here that the dividend from 2022 to 2023 had a pretty huge growth, where we have seen upwards of 55% growth. Earlier, also pretty huge growth numbers, 37%, 36, 25, 30, and so on. So what we see here is definitely a dividend growth company. You can see here the dividend growth rate over the last 10 years is actually 26%. Obviously, this is skewed by some of the big numbers, such as 44%, but you can also see here back in 21, they actually cut the dividend a lot. Scrolling down to the dividend yield graphs, you can see according to the dividend yield theory, we do have a 20% discount. As always, you can see here in the graph on the right, in the blue area, it could indicate to be undervalued, and in the red area, it could indicate that it is overvalued. But jumping into our valuation models, we do first have the Graham's revised valuation model, where we take the EPS from the company, the PE of a no growth company, the growth rate, average yield of AAA corporate bonds, and the current yield of AAA corporate bonds. Combining all those together, we arrive at an intrinsic value of $125. Next up is the discounted cash flow model, where you have the free cash flow from the different years. You then have a growth rate applied into the future. You have the future free cash flows using the applied growth rate. You then discount them back to a present value based on the discount rate. Using the cash and cash equivalents of the company, their debt, and the shares outstanding, you arrive at a fair value of $79.35. Next one is the dividend discount model, where you do take the dividend payout from the different years. Then you can calculate the growth rate using the average growth rate and the weighted average cost of capital. You can find out the intrinsic value. In this case, since the growth rate is so much higher than the weighted average cost of capital, so we actually get a negative intrinsic value. So this dividend discount model is not applicable in this scenario. Next up, we do have the multiples valuation, where we do take some peers from Fedex. Using their PE multiples, we can calculate a median PE of the company and the industry in general. Combining that with their EPS, you arrive at a stock price of $148. Jumping into the next one, the free cash flow valuation, you take the price to free cash flow ratio from the different years, average all those together. Combining that with the free cash flow per share, you arrive at an intrinsic value of $196. Last one is the Peter Lynch model, where you have the growth rate, the dividend yield, the PE ratio, combining those together to an intrinsic value of $115. Before we jump into the summary, thank you so much for watching. If you've come so far, please subscribe to the channel and like the video, and let's jump into the summary. We then have a summary of all our different valuation models. I have already excluded the dividend discount. As mentioned earlier, the growth rate was above the weighted average cost of capital, so I have excluded this one. Combining the rest together, we arrive at an average intrinsic value of $132. With the current price being at $232, it could indicate an overvalue of 75%. But as we saw from the PE ratio, which was roughly in line, and the dividend yield theory, which actually put it at a 20% discount, it's basically something you would need to figure out deeper yourself if this is a company you are interested in. There is a lot I really like about Fedex. I really love all the dividend data as seen earlier, but at the current price, I think there's definitely better ways to spend your money. I would definitely go for Fedex if it comes down towards the 52-week low of $140, but at the current price, it's not a buy for me. Thank you so much for watching, and I'll be seeing you in the next video.